information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the Gold Money Foundation podcast, hosted in association with Frisby's Bulls and Bears with me, Dominic Frisby. Now, there is a new and very interesting book about gold that's just come out. It's called In Gold We Trust. It sheds a rather more cynical light on the world of gold. It's not all bullish on gold as some books that you read are. The authors of this book are Matthew Bishop and Michael Green. Matthew Bishop is the American business editor and the New York bureau chief of The Economist. He began his career at The Economist as an economics correspondent, and he's also served as the magazine's Wall Street editor. Michael Green is an economist and writer. He was formerly a senior official in the British government, where he advised on global finance issues, and he managed the British aid programmes to Russia and the Ukraine. And he served 3 secretaries of state as head of communications. Gentlemen, welcome to the show. Thank you very much for coming on. Michael, why don't we start with you? Why don't you give us a brief outline of the book and tell us what inspired it?
Well, thanks, Dominic. I mean, the book is, we wouldn't call it cynical. I think the book is titled In Gold We Trust with a question mark, because in some sense it's sort of an economics detective story. We were inspired to write the book because some of the people we were talking to, some of the most successful investors in the world, John Paulson, who bet so successfully against the US housing market, Ray Dalio, who's now the world's #1 hedge fund manager, George Soros, who of course is a legend. All these really serious investors were talking about their interest in gold. And seeing gold as a good bet. And we just thought this was a fascinating subject, given that so much of the economics profession and the media is so dismissive of gold. So the book is really an attempt to sort of say, well, what's going on with gold? What does this tell us? And so we go through some of the history of gold and how it's been used and the story of the gold standard. And really what we're saying in the book is that we're at a moment now in the world given the state of the global economy, given the whole problem of this highly leveraged recession that we're going through, is that we think that at some point governments are going to have to respond to the crisis using inflation. And inflation is going to be the best scenario possible for gold. So gold is the canary in the gold mine, telling us about the warning of a coming crisis in money. And so since we use gold in the book as a lens to understand what's going on with money and the global economy in total.
Okay, excellent. And Matthew, do you have anything to add to that?
No, I mean, I think that's the key point, that, gold is 10 years ago, the end of the 1990s, all the conventional thinkers, all the great and the good, dismissed gold completely. They said it was, a historical anachronism, that it should be in the dustbin of history, but even Warren Buffett today still says that it's only kind of crazy people have anything to do with gold. And I think in the course of writing the book, we've become convinced that that's not the case, that the reason gold has gone up is that some of the smartest people in the world as investors have seen reason to worry about the quality of government-backed money, and they see gold as an alternative currency. And I think they have good reason to do that. Now, I think the question that we have now is what happens next to the price of gold. There's been this sort of withdrawal or fall from the peak in the last few months in the price of gold, and we wonder what that tells us. And at the moment, we think it doesn't tell you very much about the long-term scenario for gold, because we still think the underlying risk factors are there that drive gold higher. But there is a moment of uncertainty at the moment, which is due to the fact that people are getting very worried about things other than inflation at the moment, and we think inflation, as Mike said, is ultimately when gold performs best, and we think inflation is probably going to come.
Michael, you mentioned Paulson and Soros as 2 people who've invested in gold. Didn't Soros a year ago say to sell your gold? And didn't Paulson lose a great deal of money last year?
Yes, and there's also rumours that Soros has gone back into gold. I think trying to read George Soros's intentions from his public pronouncements is a very difficult game. I think what we argue in the book is gold has got to be thought of as a long-term investment based on this long-term scenario. Because I think some people backing gold, including Paulson, have very much based the argument on the big move around quantitative easing in 2009 was going to feed into inflation by 2012. And we think that may or may not be right. But to us, the real driver of this inflation scenario is going to be the politics. So even if inflation isn't coming through now, all the politicians around the world dealing with a debt crisis, ultimately the only politically feasible route out of this is going to be inflation. And that's going to be an issue I think that's going to hit the US quite soon. Especially given the choice of do we try and really tackle the deficit or do we try and inflate it away? And inflating it away is going to be a very politically appealing route for any political leader.
Is it appealing to Angela Merkel?
I think it's appealing to it obviously it's not appealing to Angela Merkel, but I think the question that we're seeing in Europe at the moment is, if people want the euro to survive, they're going to have to find a way to to stimulate the economy of places like Greece, Ireland, Italy, Spain, Portugal, France even. And, we think the only way that ultimately they're going to be able to stimulate those economies is going to be to print a lot of money and create a lot of inflation. And at the moment, Merkel is resisting that very strongly, but we think she's increasingly marginalised, and we're starting to see a realisation amongst the European elite politicians that if they want to keep their euro dream alive, they can't do that by pursuing austerity policies. Now, whatever you think about austerity policies, and there's in some ways a lot to be said for them because they do offer the prospect of keeping paper money sound. I think that they are extremely painful. And what we've seen already in Europe is that the electorates really don't like austerity, and that they're not going to support austerity in the very long run. And so our prediction is that the mood will change quite sharply in Europe over the next year or two as the public reacts and says, if you want to keep the euro, you've got to find a way to make the economy grow at the same time. And that's going to require a lot of money. Is printing
money inevitable?
A great example of this political dilemma was a poll that came out in Greece recently that showed strong opposition to austerity and strong support for staying in the euro. I mean, you can't square that circle without some inflationary response to try and deal with that debt problem across the eurozone. So I think that's the real driver as far as we're concerned, is there's that politics is going to push. As Matthew says, Germany may resist, but in a sense it's the politics of the eurozone as a whole that's going to be the key question for the future of the euro.
And Merkel will have to go to the German people at some point and say, look, this is your choice. Are we going to be good Europeans, or are we going to insist on the kind of tough money policies that Germany has had for a long time? And Paul Krugman, who is no fan of gold, has made this point in his latest book that it wasn't actually inflation that brought about the rise of Hitler. It was the tough policies that followed inflation, the austerity policies. And so, I think he actually is one of the voices that is now increasingly calling for governments to take on inflationary policies. And, the voice of the New York Times and so forth. And I think that is going to be increasingly a bellwether for where other commentators and politicians are increasingly going to be going.
Can you just define inflation, what you mean by inflation for me?
Well, I think what we're going to see from governments is, my guess is we'll see politicians maybe around the talk of growth pacts, talking about ideas like nominal GDP targeting. And that's the idea that your nominal GDP should grow by a fixed amount per year, say 5%. And that means that if your economy is growing at a thumping 5%, you're looking for zero inflation. Whereas if it's growing at 0%, you're looking for 5% inflation. And that's the kind of range that Krugman is talking about. So I think we're going to be seeing politicians looking to target that kind of inflation rate and not declaring a pro-inflation policy, but but declaring a policy that's saying we're looking to keep nominal GDP growing.
Okay.
And inflation comes behind that.
One of you guys, can you just define inflation? What do you mean by inflation?
The usual definition of inflation is that the same basket of goods and services that a consumer would want to buy costs more.
So rising prices, in other words.
Because there's an increase. It's rising prices due to an increase in the amount of money. So a reduction in the value of the money of a dollar, essentially, because more money is being printed. So you don't mind rising prices if you're getting higher quality, but inflation is when you get higher prices without any change in essentially the quality of the goods you're getting, and that's usually a phenomenon brought on by an excess supply of money, which is why when central banks have been doing quantitative easing over the last couple of years, people have expected inflation to pick up. Now, the fact is that the economy is, in most of the developed world, is in such a slump at the moment that increase in the money supply hasn't fed through to inflation as quickly as it might do if the economy was nearer full employment. And but we think ultimately the advantages of inflation to government, because they reduce what it actually costs to pay off your debt if you're a government. Inflation is very good at reducing the real value of debt. They will choose to print lots of money in order to increase inflation and reduce their real debt burden, which gets them out of the political bind that's only at the moment, where they're faced with this very unpalatable choice between either raising taxes or cutting spending, or both.
Okay, is it possible for gold to rise if governments take the austere route and don't print money?
Well, I think if austerity leads to an economic recovery, then that's going to be probably the worst scenario for gold. If austerity leads, as someone like Krugman warns to a long depression, gold will probably hold its value pretty well. The challenge we really put in the book is, what can you see as being the most likely scenario to go ahead? Do we really think that we're going to see political will to cut deficits and to really stabilise government finances and stabilise paper money? The argument against gold, I think, is a very optimistic one, that somehow recovery is just going to come without governments having to print money. And I find it very hard to see as a scenario. But that would be the worst one for gold.
Okay.
And it's worth bearing in mind, the point at which the gold price hit its lows at the end of the 1990s was the point when general faith in central banks and government being able to manage economies without having high inflation, high unemployment, was at its highest level. There was this massive faith. People thought Alan Greenspan was God, and anything he did would keep everything ticking along very nicely. And the reason I think gold has gone up significantly since then has been, and this is one of the points we're making in Gold We Trust, has been because, for good reasons, we've come to have doubts about the competence of those people in charge of the economic system, particularly people running central banks and treasuries. And the question we have to ask going forward about gold is, are we going to feel better about those people in the next few years, or are we going to feel just as depressed as we do at the moment? And that, my sense is there's very little evidence that they're getting their act together, certainly not in Europe. And I don't imagine that the election in the US is going to make us feel inspired by the competence of their economic policy making.
So, by your reasons for investing in gold are basically a bet on future money printing, a bet on governments not taking the austere route but taking the inflationary route. We're going through a crisis in Europe where policymakers seem to be floundering. There's no clear solution. And yet gold has fallen quite dramatically. It hasn't been the money of last resort, the ultimate safe haven. Government bonds have. US, UK and German government bonds have. Can you explain why that is?
Yeah, it's a great question, Dominic. What's really happened is that the euro worries have pushed money looking for other safe refuges. And so one is going to be German bonds, because even if the Eurozone breaks up, Germany, people are pretty confident, is going to survive. And actually probably the value of the new German currency would soar. There's the UK, which seems to be reasonably safe. But the really big place that's able to absorb that much liquidity is the US dollar. And I think it really is this point about the dollar still enjoys its position of being the least worst major currency. As Thomas Kaplan, one of the investors we interview in the book, says, all paper currencies are toilet paper, the dollar's just double ply. And I think the reason the dollar is enjoying this some trust at the moment is because in a way the US has kicked a lot of the economic questions into next year. The deal around the budget that was done last year between Obama and Congress means that the really big issues around the deficit are going to be dealt with. The reasonable performance of the US economy this year has not led to more quantitative easing so far. But again, I think what you're going to see later in the year, if there are worries going into the election, particularly, given the Federal Reserve's dual mandate to maintain employment as well as tackle inflation, there's going to be pressure for some other form of quantitative easing to occur. So I think at the moment there's sort of the gold has suffered along with a lot of other commodities due to the strengthening of the dollar as an alternative to the euro. But once people focus on the quality of the dollar as a store of value, I think that's going to be the thing that's going to drive the next surge in gold.
Yeah, and I think the other point is that I think gold as a hedge against Armageddon doesn't really work very well, except in the most extreme circumstances where you feel the banking system's about to collapse in a spectacular way or society's going to fall apart. Gold. Our argument is gold is much better as a hedge against inflation, and so. I think safe haven properties are real, but at the moment people, are, I think, relatively less panicky than they were, say, last September, when the euro first hit its latest crisis.
Okay.
And they're more sanguine than they were in March of 2009, where it looked like the whole banking system globally was about to collapse, and so people were saying, well, we've got to put smart people were saying we're going to put our money in whatever we can that would survive a banking crisis of that magnitude. And we're not at the point where anyone, I think, is predicting a complete collapse of the banking system at the moment.
Do you gentlemen both own significant amounts of gold in your portfolios?
I mean, unfortunately, as a journalist, one of the restrictions I'm under is that I'm not allowed to actively manage my money in a way that I would be able to write about it. It would prevent me from writing about it if I did. So I'm not in that position.
Yeah, same thing.
I'm a journalist. I'm allowed to own gold.
Yeah, it's the rules of the economist. Unfortunately for me.
You want to come over to Money Week, chaps?
Is that
it's an interesting intellectual question. I think in some ways it would be nice to be able to enjoy the fruits of your own insights and to put your own risk out there, but that's just the way.
So if you work for the Economist, you're not, and you say that government bonds are a good buy, you can't own government bonds.
The point is, anyone writing about anything that they have a potential interest in, is restricted.
Even if it's a market as big as gold or government bonds or whatever it is. I mean, I can understand.
Yeah, basically, basically they say, it's got to be a passively managed investment portfolio, ideally through you can put it into an index fund or something of that kind, but nothing where you would have an incentive to write stuff that would potentially influence prices.
Okay,
in your favour.
I understand. What are your long-term goals for gold, gentlemen?
That's a very interesting question, because I think that what this crisis has shown, and the fact that gold has come back, reveals that our existing monetary system has serious problems. And so I hope that we will see a lot more serious debate about how do we create a better system of money, in which I think gold will play a role, but also maybe there's some other currencies that will be developed. And so I've become a big fan of Friedrich von Hayek's thinking about how we should have competitive currencies in a much more serious way than we've had in the past. And so I'd like to see gold as a sort of way that an arrow pointing in that direction. But in terms of where it goes, the price, in some ways I'd like the price of gold to fall, because I think it will only fall if governments get their act together and manage the economies properly and where they're supposed to. But I'm unfortunately very sceptical that they're going to do that. So I'm suspecting that we could easily see the gold price go much higher, particularly at the moment. It's being driven up by institutional investors, by smart, intelligent individual investors, but not by the general public piling into gold. And I think once we see signs of inflation, the public will move into gold in a big way, and that's when you'll see prices surge, and they could easily go through 3, 4, 5,000. Who knows what?
You say
what the limit would be.
You say that the public aren't in gold there. When I write an article for Money Week on gold, the only subject that gets more interest in terms of the amount of hits the article gets and the amount of comments that are posted below is the UK housing market. Gold is the most popular financial subject.
It is, I think, but that's amongst members of the public who I think take an interest in their investments. But I think for the sort of the great amount of passive money that's sitting in sort of very low interest rate accounts, money market funds and so forth, that public hasn't engaged seriously with gold yet. And, because they think inflation is never going to come back in a serious way. But I think if they start to see inflation return, you wait to see how much interest there's going to be in gold and the number of articles recommending buy gold. And I think you'll suddenly see, a huge flow of money into what is, an asset with a relatively limited supply. And so that's when you see the price go through the roof.
In your book, you say that a return to a gold standard is unlikely, it's unrealistic, it would be extremely deflationary. Is a return to a gold standard a realistic outcome to all of this?
Not in the old classical sense of governments issuing money backed by gold. I think there's sometimes people sort of see this idea that we return to the gold standard and everything will be fine. And this is one of the reasons why, in Gold We Trust uses history to inform how, in the past we have tried to sort of restore the stability of currencies by going back to a hard gold standard. Britain after the Napoleonic War, the United States after the Civil War. And that has had very strong deflationary implications, causing long recessions. And since the problem that the gold standard ran into in the 20th century was the rise of democracy and organized citizens who really were saying you can't do this. Britain tried to return to the stability of gold after the First World War, and it just wasn't politically possible to impose that degree of austerity on the public.
What's the reason? Let me put something to you very quickly.
Yeah.
What's the reason that on those 3 occasions that you mentioned, returning to a gold standard caused a deflationary slump? The fact that they went on at the wrong rate.
There's a question, I think, about the rate at one point. But then what says if you go on at a different rate, you're still saying you've got less money in the economy.
Not if you revalue gold upwards.
But then you've got a global market for gold.
Let's say if you were to take the United States as an example, it has 261 million ounces of gold in Fort Knox. If you were to value United States debt at the value of its gold holdings and revalue the gold holdings upwards, you'd be looking at something like $10,000 an ounce gold, if that makes sense. And let's say you want to create a bit of excess. You want to recapitalize what essentially are undercapitalized markets. So you would have to revalue gold upwards even more. What about the possibility of going back onto a gold standard at something like $15,000 an ounce? Why would that not work?
Well, if you go at $15,000 an ounce, you've then had massive inflation. That's been one effect.
And then you've got to persuade the Chinese to go along with that as well.
Yeah, and then you've got a global market where people have got to accept that for that value. And then going forward, you've still got the point that you've got a relatively fixed monetary supply.
But I'm not saying, I agree. In terms of political acceptability, it's a fantastic, absurd idea, and it's just unrealistic. But in terms of recapitalizing the markets and not being deflationary, why can that not work?
Well, no, that wouldn't be, since that would be inflationary.
Well, that's my point, though. So it doesn't have to be deflationary going back to a gold standard if you value it at the right rate.
So that one-off level, you're then basically doing inflation, which is what you're trying not to do. Yeah. And then what you're saying, it's revaluing gold upwards. For example, if you look at the Dow's currently trading at, say, $12,000 an ounce. The long-term historical ratio between the Dow and gold has been 1-to-1. Not the long term. Through the 19th century, it was 1-to-1. If you were to go back to a 1-to-1 ratio, you would revalue gold to $12,000 an ounce.
we've had the inflation, the money and credit has been created, and all you're doing is...
Right, but the point is you have these two things going on. You have a transition effect, what happens when you do the transition. And as Mike said, in that particular example, you might have, it could be inflationary, it could be deflationary. But then you have this long-term issue, which is that the supply of gold is very fixed, and therefore you don't have the flexibility to adjust your money supply to take account of fluctuations in the economic cycle. And what history has suggested is that when you have a gold standard with a fixed relationship between the supply of money and gold, what Marshall called the hazards of mining, really affect your ability to respond to periods where demand is weak. And so that's why it's tended to have this deflationary impact. And this is why Frederick Hayek called it a wobbly anchor, because it just didn't really do the job that you would want whatever was backing your currency to do. It forced you to maybe suffer from these long-run tendency towards being deflationary, even though there are periods where, depending on what you do and setting the rate, where it can have an inflationary impact.
Is deflation such a bad thing?
For example, if these... One of the things we mentioned in Gold We Trust is that, there are these people who are now looking at going into space and mining all the gold from the asteroids, and you could imagine them coming back and flooding a gold standard market with gold from outer space, and then you would find it was very inflationary.
Yeah, well, that's what happened to Spain, effectively, isn't it?
Yeah, exactly. So, so it isn't always deflationary, but I think when you are in a situation where the supply is fixed, it tends to have disadvantages that manifest themselves most in periods where you would most want to be able to stimulate the economy through increasing the money supply.
Given the fact that we have a generation under the age of 30 who have been completely priced out and are enslaved to debt and have no hope of buying houses and finding proper employment and have to delay having families and so on and so forth, is a bit of deflation such a bad thing? It makes the world a lot more affordable to them. Is this fear of deflation merely propping up the assets of the baby boomers?
I think the second part is right, the first part is wrong. So if you have deflation, what that's going to do is actually increase the current cost of the debts you've incurred in the past. So in a sense, the young people coming through, as we have to pay off those debts we've incurred in the past, those debts are getting ever larger if we've got a declining price level. And again, this is one of, I think, the elegances for politicians of the inflationary route, is that if through inflation you can reduce the real value of the debt, if you can reduce, in a sense, steal from the baby boomers, then you're actually doing an intergenerational redistribution from savers to borrowers, from old to young. And I think this is going to be one of the big reasons why inflation is actually good for the younger generation and bad for the older generation.
Okay, well, gents, it's been fascinating talking to you. We've run out of time there. The book is called In Gold We Trust. Why don't you tell us, one of you, Michael or Matthew, where we can buy it? It's very interesting.
It's out on Amazon. It's on Kindle. It's very reasonably priced.
So you go to amazon.co.uk, amazon.com. And it's only $2. It's very, very cheap because of the way Amazon treats its authors, rather punitively.
We lose, you all win.
And is it coming out in hard copy or only as on Kindle?
Hopefully before long it will do, but currently it's only available as an ebook on Kindle.
Okay.
But you can actually have it on your iPad app as well as you get the Kindle app on. Download it onto your iPad. That's
how I read it. I read it on my iPad and I enjoyed reading it very much. Gentlemen, Matthew Bishop, Michael Green, it's been a real pleasure talking to you. The book is called In Gold We Trust. Thank you very much for coming on the show.
Thanks, Dominic.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.